Welcome to today's investment story, where we dive into Intel Corporation from the perspective of a seasoned value investor. So grab your favorite cup of coffee, sit back, and let's talk about this semiconductor giant. But remember, this isn't financial advice, it's more like a friendly chat. So why would a value investor even bother looking at Intel? Well, let's walk through the reasons, keeping our analytical glasses on, but with just a touch of humor to keep things lively. First up, let's acknowledge the elephant in the room. Intel's stock price has been more volatile than your uncle at a holiday dinner. Yet, that's precisely why value investors might start getting interested. As of today, Intel's stock is trading in the low 20s, and some analysts believe it's well below its intrinsic value. The intrinsic value argument. Various estimates put Intel's intrinsic value between $28 and $30 per share, depending on which financial wizard spreadsheet you trust. Using models like discounted cash flow, which is basically an excuse to play with Excel formulas, Intel appears undervalued by about 20 to 30%. Not bad, right? Now, we're not talking about a quick flip here, no. This is the kind of long-term value play that requires patience, like waiting for a turtle to cross a busy road or your slow cooker to finish a roast. Intel's key financial metrics. Intel's price-to-earnings ratio is currently around 14.5, which is significantly lower than the semiconductor industry average of about 25. This means investors are paying less for every dollar of Intel's earnings compared to its peers. A potential value indicator? Sure. But it could also mean that the market has some serious doubts about Intel's growth prospects. After all, it's like buying a used car at a discount. You wonder if the engine is about to blow. The price-to-book ratio sits at around 1.5. This metric compares the stock's market value to its book value, or the value of the company's assets minus liabilities. A price-to-book ratio under 2 for a tech company is pretty rare and could mean Intel's stock is undervalued based on its tangible assets. But of course, book value can be misleading. It's like thinking your old vinyl collection is worth a fortune when it's really only valuable to you. Intel's debt-to-equity ratio stands at a manageable 0.4. This shows that Intel isn't overly reliant on borrowed money to finance its operations, a good sign in case the global economy decides to throw another curveball. So we've got a company with a solid balance sheet, but here's a cautionary note. If you're not taking on enough risk in the tech world, sometimes you're just treading water. And speaking of cash, Intel's debt-to-cash ratio is roughly 2.5. For every dollar in debt, Intel has 40 cents in cash reserves. Not bad, but not swimming in liquidity either. It's like having a decent emergency fund. Good enough to cover a few surprises, but not enough to buy a yacht. Intel's master plan for growth. Let's talk strategy. Intel's CEO, Pat Gelsinger, has a bold plan to restore the company's former glory. It's called the 5 nodes in 4 years strategy, which sounds impressive even if you don't know what a node is. Essentially, Intel wants to outpace its competition by developing more advanced manufacturing processes. Oh, and they're diving headfirst into artificial intelligence, adding AI features to their product lineup because, let's face it, if you're not doing AI, are you even in tech anymore? Manufacturing expansion and foundry services. Intel is also doubling down on its foundry business, setting up new facilities in the United States and Europe. It's a bit like opening a new pizza place in town when you already have a reputation for making great crust. Diversification, baby. But here's the kicker. Intel's foundry services will operate as an independent entity, complete with a separate board of directors. If you think corporate governance can't be exciting, well, that's fair. It probably isn't. But this move is crucial to attract outside clients who care about intellectual property security. Geopolitical uncertainties. The Taiwan question. Now let's discuss the geopolitical wildcard, Taiwan. It's home to TSMC, the world's leading chip manufacturer. If China were to invade Taiwan, well, let's just say the global semiconductor industry would be in more trouble than a cat in a rocking chair factory. Here's where things get spicy for Intel. In that chaotic scenario, Intel, with its domestic manufacturing capacity, could become an indispensable partner for tech companies and governments scrambling to secure chip supplies. A national hero, if you will, but without the cape. Just a bunch of engineers in lab coats. However, we shouldn't underestimate the risks. A conflict in Taiwan would likely lead to a global recession, supply chain chaos, and increased costs for raw materials. Even Intel, with all its newfound strategic advantages, might struggle to swim in those turbulent economic waters. Financial stability and cost management. The good news? Intel's got a war chest, strong cash reserves, and a cost-saving plan of $10 billion. Yes, they're even trimming some fat, aka workforce reductions. Not the most cheerful news, but it keeps the lights on for their ambitious projects. So, is Intel a value play? In conclusion, Intel is a classic value play, a beaten-down stock with a solid balance sheet, undervalued based on intrinsic analysis, and a bold growth strategy. But let's be real, investing in Intel isn't for the faint of heart. It's like buying a fixer-upper with potential. You've got to believe in the transformation, even if the kitchen still looks like it's from the 70s. So what do you think? Is Intel a bargain, or just a case of a company trying to relive its glory days? Either way, it sure makes for an interesting investment thesis. Thanks for listening, and may your portfolio be as solid as your humor.